Okay, let's kick us off. We're diving deep into, well, a whole stack of sources today. And they paint a really fascinating picture, sometimes a bit turbulent, of the global economy and some key business sectors, too. We've got everything: the impact of new trade policies, the latest tech earnings, even how companies are innovating to tackle some, frankly, massive challenges. Our mission today, really just to pull out the most important nuggets, help you get truly well informed without getting buried in all the details.
Exactly. And it's such a dynamic landscape right now. You've got political decisions, consumer behavior, tech advancements, all creating these ripple effects. What's really striking, I think, is how these pieces that seem separate, they actually connect. They give you this broader picture of what's happening right now, and crucially, what it might mean for you.
Definitely. And the most immediate tremors, it feels like, are coming from global trade, especially with President Trump's sweeping new tariffs. They're coming into effect this week. So, what are the sort of broader ramifications here for global trade?
Yeah, that's the big question, isn't it? Who's really feeling the squeeze the most? What we're seeing is nations that haven't locked down specific trade deals, or at least, outlined some terms, they're facing these import duties, anywhere from 10% up to 40%. Now, the administration has managed temporary truces with Mexico and China, keep those negotiations going. But yeah, other key trading partners are definitely in the spotlight.
And India seems like a particularly complex case among those. The president announced he'd substantially raise tariffs on Indian goods, up to 50% total levy. What's driving that specific significant hike?
Well, if you place it in the bigger picture, the stated reasons, they include New Delhi's ongoing purchase and resale of sanctioned Russian oil. The U.S. argument is that this helps sustain Moscow's wartime economy. But there are other factors, too. India's own sort of protectionist trade practices, their existing high tariffs, those were cited as early sticking points as well.
India's pushing back hard, though, right? They're arguing it's unfair targeting, especially, I guess, when the US and EU are also trading with Russia. They're emphasizing that their imports ensure, and this is a quote, predictable and affordable energy costs for, 1.4 billion people, calling it a necessity compelled by the global market situation.
Hmm.
It's interesting, too, because didn't the US previously kind of encourage India to buy Russian oil to stabilize crude prices?
That's a really critical point, yeah. And economists, initially anyway, they only expected a, quote, marginal downside hit to India's economy because their trade is pretty diversified. And it's worth remembering, key sectors like pharmaceuticals, semiconductors, electronics, they're actually exempt from these new tariffs.
But other industries.
Yeah, things like gems and jewelry, apparel, textiles, chemicals, they're definitely more vulnerable.
Okay, so beyond India, other big economies are facing these headwinds too. Canada, for example, America's second largest trading partner. Their tariffs jumped from 25% to 35% on steel, cars, things not covered by USMCA. And Canada hit back pretty quickly, $43 billion in tariffs on US goods. Brazil, too, facing a steep 50% tariff now.
It really shows these standoffs deepening. And sometimes, the reasons aren't just purely economic. Brazil's tariff increase, for instance, is widely seen as retaliatory. Over the trial of former President Bolsonaro, which the U.S. president called a witch hunt, Brazil's current president, Lula, he's denounced the tariffs flat out as economic blackmail. So negotiations there are pretty much stalled.
And then Switzerland, known for neutrality, suddenly hit with a 39% tariff. That seemed to come out of nowhere, right? Especially since it looked like a trade agreement was almost done. What's the thinking there?
It is striking. The U.S. president cited concerns about the trade deficit with Switzerland, even though, interestingly, the U.S. has a significant surplus in services with them. But the really intriguing part, maybe worrying for them, is this added threat of sector-specific tariffs. On pharmaceuticals, those could potentially skyrocket to 250% within 18 months.
Wow.
Yeah. And considering life sciences make up, 38.5% of Swiss exports, that's a huge potential blow. Plus their currency, the Swiss franc, it's surging because it's seen as a safe haven.
Yeah.
That's adding more economic pressure. It's actually pushing the Swiss National Bank to consider, more accommodative action, lowering rates maybe, even if, as they put it, it might incur the wrath of the U.S. administration.
So beyond specific countries, there's this broader shift too. Suspending the de minimis exemption that used to let small shipments under $800 come in duty-free, right? Mostly from China, affecting giants like Shein, Temu. How does closing that back door translate for you, the consumer?
Yeah, that's the key question again. Who actually pays? The duties on these things that used to be exempt could be $80 to $200 per item. And, some of that cost, probably a good chunk, could get passed directly to consumers. You might see prices go up. On the other side of the coin, though, the U.S. government's tariff revenue is way up. Nearly $30 billion last month alone. That's a 242% jump from last July, and $100 billion just since April.
Right. And the president's floated ideas for that money, paying down debt, maybe even tariff rebate checks for Americans, sounds potentially good, but what do economists make of that idea?
Well, you've hit the nail on the head. Economists are pretty wary. They warn distributing that cash could actually fuel inflation, maybe even widen the deficit in the long run, even if it looks good for government books short term. And the uncertainty around all these tariffs is already causing businesses to pause hiring. We're seeing fewer job openings. That could potentially shave, half a point off U.S. GDP this year and next. And some businesses are already raising prices. Appliances, toys, electronics, those tariff-sensitive goods.
Okay, speaking of jobs and the economy, there's been quite a bit of controversy around the recent jobs reports. The Bureau of Labor Statistics. The president fired the BLS commissioner, Dr. McIntyre, claiming the numbers were, quote, rigged and faked. This brings up a really crucial point about, well, trusting our economic data.
It absolutely does. And it makes you think about data integrity. The BLS, it's important to remember, is an independently operated body. Their job is collecting this vital economic data. They use two main surveys, one of households, one of businesses, and their process involves editing, extrapolating, seasonal adjustments. And critically, the data gets revised, multiple times actually, as more information comes in. That's just standard statistical practice. It's normal. What's maybe noteworthy here is that the recent revisions for May and June, they did shave off a combined 258,000 jobs were historically large. But, crucially, not unprecedented. We saw bigger revisions during the pandemic, definitely, and even back in 2009.
So the claims of a scam or manipulation, they don't really hold up against how the BLS actually operates. But the report itself, the underlying numbers, did show some concerning signs, didn't it?
Indeed. The July report showed the U.S. economy adding, on average, just 85,000 jobs per month this year. That's way below the 177,000 pre-pandemic average. Unemployment also ticked up to 4.2%. And historically, revisions of that size over 2 months, they have often coincided with recessions. Now, other economic indicators aren't all flashing red just yet, but this data, it certainly gives economists, as they say, agita, significant concern.
And why does the integrity of this data, the jobs numbers, matter so much for all of us?
It matters profoundly because businesses, investors, crucial institutions like the Federal Reserve, they all rely on this data being accurate and credible. They use it to make huge decisions about investment, hiring, monetary policy, interest rates. Undermining that trust, as some economists are warning, it can lead to businesses essentially flying blind. And that could actually make economic problems worse, potentially even raise borrowing costs for consumers, for you.
Okay, and that ties nicely into the Federal Reserve itself. There's a new open seat now on the Board of Governors. Adriana Kugler resigned unexpectedly. This gives the president a strategic chance, maybe, to appoint someone who aligns more with his desire for immediate rate cuts. What are the potential implications here?
Well, the president's been very vocal criticizing Chair Jerome Powell and the Fed's high interest rates, called Powell too late, even worse sometimes. Powell, for his part, has maintained rates stayed steady because the economy was robust and also because of all this tariff uncertainty. So now, the president's reportedly considering candidates like former Fed Governor Kevin Warsh, maybe NEC Director Kevin Hassett. There's even talk of appointing a kind of shadow chair, someone who'd act as an instigator now before potentially taking the top job when Powell's term ends in May 2026.
That's really interesting. What's fundamentally at stake here with these appointments, with this continued public pressure on the Fed?
It really brings up the whole question of the Fed's independence, its ability to make policy decisions based on economics, not politics. Even making unpopular decisions, like raising rates that might hurt jobs short-term to fight inflation, that's seen as absolutely vital for the long-term strength of the U.S. economy. So politicizing appointments or decisions, as economists warn, could erode public faith, investor faith. And that could actually drive up bond yields, make borrowing more expensive, increase your cost of living. It shows how politics and economics can get really tangled.
Okay, let's shift gears a bit. From the big macro picture down to individual companies, we're seeing businesses navigating all these cross currents with, well, a mix of resilience, innovation, and some pretty big challenges too. Let's start with tech and travel maybe. How are some adapting there?
Yeah, what's quite striking is how some are actually thriving, despite what everyone calls this volatile macroeconomic backdrop. Despite the market chaos from tariffs back in April, Airbnb, for instance, beat analyst expectations in Q2. Revenue up 13% year over year, and nights booked actually accelerated from April through July. Similarly, DoorDash. Shares climbed after they beat earnings and revenue estimates. Total orders up 20% from a year earlier. And they're making strategic moves too. Acquisitions in food delivery, restaurant tech. Seems like they're aiming for broader market dominance.
Lyft, though, had a tougher time. Missed revenue estimates, citing competition with Uber, weaker U.S. travel demand. Suggest maybe a different strategy is needed in that ride-hailing space.
They're definitely adapting, yeah. Lyft recently bought a European mobility platform, signed a deal for robotaxis in China. They also announced a partnership with United Airlines for rewards points. If you put that in the bigger picture, it kind of suggests that maybe growth is slowing down in the big U.S. cities. So ride-hailing companies are shifting focus, looking at medium, smaller, maybe more car-dependent cities. And international markets, trying to find new avenues for growth. It's like pursuing new frontiers as the main urban markets get saturated.
Okay, next up, let's dive into how some companies are innovating with their actual products, their media strategies. We're talking everything from dating apps to chocolate.
Right? Match Group, they own Tinder. Hinge, their stock jumped over 10%. Signal the turnaround. Their new CEO is pushing for, quote, urgency and product obsession. They're rolling out AI-powered discovery tools, a double date feature, targeting younger users, 90% are under 30. They're planning to reinvest $50 million in new product development. Focus on Gen Z international growth.
Yeah.
It really makes you wonder, how is AI going to keep reshaping our social lives? It's moving way beyond just simple matching now.
Okay, now this one really stands out. Mars, the candy giant, partnering with a biotech firm to gene edit cocoa using CRISPR technology. Why are M&Ms and Snickers getting into genetic engineering?
It's actually a really forward-thinking move. It's directly about tackling climate change impacts on their core ingredient. The goal is basically to create cacao plants that are more resistant to disease, to heat, other climate stresses, essentially protecting the global chocolate supply for the future. It's more than just saving chocolate, though. It signals a fundamental shift, I think. Companies aren't just adapting anymore. They're actively trying to rewrite the genetic code of their key inputs. It's not just sustainability talk. It's like biology as the ultimate insurance policy for their supply chain. We saw Starbucks do similar things, investing in climate-resilient coffee farms. It's a broader trend.
Okay, McDonald's. They finally saw sales turn around after 2 down quarters, thanks partly to their biggest marketing campaign ever, the Minecraft movie meal deal. What's the real story behind that turnaround?
Well, the fascinating part is just the sheer power of synergy there. The promotion ran in 100 markets right when the movie was grossing nearly $1 billion worldwide. But despite that win, they still saw declines in visits from lower-income consumers. Those folks are really sensitive to core menu prices. So McDonald's is now focused on re-engaging them. Value meals, new offerings. And they actually admitted pretty directly that combo meals over $10 are, quote, shaping value perceptions in a negative way. That's a rare bit of insight into pricing psychology from a huge brand.
Right. Now, in AI again, OpenAI, offering its ChatGPT Enterprise product to U.S. federal agencies for just $1 for the next year, deepening ties with lawmakers, regulators. They even got a $200 million contract with the Department of Defense. That seems like a huge push into government.
That's exactly it. It indicates a really significant drive to get these powerful AI tools integrated into federal operations. The aim is to make government services faster, easier, and more reliable. It also just signals OpenAI's growing influence, their ambition in the public sector. They're even opening their first office in D.C. The key question this raises, though, is about the long-term implications.
Right.
What happens when these powerful AI tools become central to how governments actually work and interact with citizens?
And in media news, the New York Post is heading west, launching the California Post in L.A. next year. What's the strategy there?
It seems like a bold move, yeah. Trying to capitalize on what some see as California's, well, weakened news media landscape. The state's lost a third of its newspaper since 2005, so they're looking to bring their style, fiery, gossipy writing, a common-sense issue-based approach to a new market, directly challenging the established Hollywood gossip publications, but also aiming to engage the 3.5 million readers they already have digitally in LA. It kind of shows that even now, local news coverage, especially with a strong voice, can still find a hungry audience.
Okay, finally, let's touch on some more traditional sectors. Retail, manufacturing. Some are facing pretty significant headwinds.
Yeah, ELF Beauty, for example, their profits fell 30% last quarter, primarily blamed on the new China tariffs. 75% of their products come from there. They've already raised prices by $1. And they're working hard now to diversify their supply chain, move production elsewhere. It just highlights that crucial point again, how dependent companies are on these global supply chains and how fast trade policy can hit the bottom line, forcing price hikes that you eventually feel.
And Claire's. That mall staple for tweens, filing for bankruptcy again, second time in less than a decade. What's going wrong there?
It's really a stark example of that, quote, cocktail of problems facing physical retail. Intense competition from online, sure. Mounting debt, but also, specifically for them, the uncertainty from tariffs is a big factor. They rely heavily on importing cheap goods from China, other parts of Asia. It just underscores that ongoing, relentless shift away from traditional retail and how fragile companies become if they can't adapt really quickly.
And lastly, Jaguar. They unveiled a new brand identity. They actually stopped making cars entirely in 2024 to reinvent as an electric vehicle maker, but they also faced misleading sales headlines, political flack over a supposedly woke ad campaign. What's fascinating is just how a legacy brand like that navigates such a drastic make-or-break transformation.
It's a monumental challenge, no doubt. And despite some political rhetoric trying to pin blame on their marketing, Jaguar's problems run deeper. A stale product lineup for a while, really
Yeah.
stiff competition in luxury cars, and just the incredibly difficult capital-intensive shift to electric. Their decision to halt production completely, it just underscores the massive commitment, but also the massive risk involved in this complete reinvention. It's a huge gamble on the future of cars, really.
Wow. So, as you can really see from this whole deep dive, the world of business, economics, it's just this complex web. Everything's interconnected, every piece influences something else.
Exactly. Whether it's, the ripple effect of tariffs ending up on your favorite beauty products or the strategic decisions behind the ingredients in a chocolate bar, understanding these forces really helps you make sense of the news swirling around you.
Hmm.
I think the real takeaway here is to consider just how deeply intertwined things like geopolitical strategy are with what you actually pay for everyday goods and how quickly those dynamics can shift.
It really makes you think, doesn't it, about the choices companies, governments are making right now, and how those choices could shape the next few months, the next few years for all of us. What insights really resonate most with you after digging through all of this?